Hey there, and welcome to This Explainer. Today, we're diving deep into the ultimate insider secrets that top-tier equipment vendors are using to absolutely dominate their markets. We're talking about completely eliminating buyer hesitation. You know, if you've ever felt that sting, that awful moment when a major deal slips away at the literal last second, well, you are exactly in the right place. Let's unpack the mechanics of vendor financing and strategic upselling together.
So, here's our quick roadmap for today. We're going to cover first, the cost barrier. Second, vendor financing 101. Third, the profit multiplier. Fourth, the upsell advantage. And finally, number 5, choosing the right partner.
All right, let's jump right into Section 1, the cost barrier.
Okay, I'm almost positive you've experienced this exact scenario. The buyer loves your equipment, right? They see the value, they absolutely know it's going to level up their operations, but then, right at the finish line, after weeks, maybe even months of back and forth negotiations, the deal just mysteriously dies. They suddenly ghost you, or you get the classic, we need to push this to next quarter line. So why does this happen?
Well, it all boils down to this crucial point. Buyers are incredibly hesitant to just drain their working capital, especially when the economy feels uncertain. That upfront cost is a massive, massive barrier. When things are complex out there, businesses tightly grip their cash. So handing them this huge invoice for the total purchase price, it instantly triggers major sticker shock. Honestly, if you aren't offering a way to smooth out that cost for them, you are literally handing over control of the sale. You're forcing them to go figure out the funding on their own, and more often than not, that just means they walk away.
Which brings us perfectly to Section 2, Vendor Financing 101. So, vendor and captive financing. Think of this as a strategic partnership that lets your buyers snag flexible financing right at the point of sale. By simply pivoting the conversation away from that terrifying total price tag to a, highly accessible monthly payment, you essentially wipe out the cost objection completely. And the best part? You don't even have to front the money yourself. You partner with a specialized lender. But for your customer, it feels like this flawless, one-stop shop experience. They get the gear they desperately need, and you get paid in full, right on the spot.
Now, within this ecosystem, you are empowering your customers with real choices. For instance, you could offer an equipment finance agreement, or EFA for short. This is essentially your classic loan setup. The buyer takes ownership of the asset from day one and starts building equity. On the flip side, you can offer an equipment lease. This means they get to use the asset without technically owning it right away. Why does that matter? Because it gives them crucial off-balance sheet flexibility, which is an absolute lifesaver if their company can't officially take on any more debt right now. Giving them the power to choose how they pay, that is a massive competitive advantage for you.
Oh, and we have to talk about the power of ownership here. 179, this refers to Section 179 of the IRS tax code. And let me tell you, it is an absolute powerhouse of a sales tool. It actually allows businesses to deduct the full purchase price of qualifying financed equipment in the exact same year they put it into service. Meaning your customer can grab that equipment for just a few monthly payments up front, but claim a massive immediate tax deduction right now. In some crazy cases, their tax savings end up being literally larger than their total payments for that entire year.
Moving on to Section 3, the profit multiplier.
Okay, let's look at the hard data, because this isn't just nice-sounding theory. A fascinating study by Siemens Financial Services showed that vendors who actually bake smart financing into their sales process watch their sales jump by an average of 20%. And their profits? Those surge by almost 25%. It's wild. It fundamentally shifts the entire buying psychology. Because suddenly, financing opens the door to higher spec models, premium upgrades, and all those lucrative add-ons.
And gets better. When you team up with specialized funding networks, the approval rates are just astounding. Take Financial Partners Group, for example. They've noted they can hit approval rates as high as 90%. I mean, that completely blows traditional bank processes out of the water. We all know banks demand mountains of paperwork, years of tax returns, and their rigid scorecards just drag buyers through the mud for weeks, sometimes months. But specialized vendor financing, it offers this slick, digital-first processing where you get answers in hours, which means your deals actually cross the finish line.
Let's actually ground this in a really practical, real-world example from the hospitality sector. So picture a sports bar wanting to buy 4 commercial pool tables. Buying them outright? That might be a $24,000 hit to their cash flow. Ouch! But if you finance them over, say, 60 months, the cost drops to about $486 a month. And here's the absolute magic of this. Those 4 coin-operated tables can easily pull in over $1,600 in monthly revenue. The equipment is literally paying for itself right out of the gate, generating positive cash flow from day one. When you frame your sale like that, it's no longer a scary cost, it's an immediate revenue generator.
Let's keep this momentum going into Section 4, the upsell advantage.
Now we really need to clarify a crucial distinction here. While cross-selling is all about adding complementary accessories, like throwing in a carrying case when you sell a laptop, upselling is the real art of guiding your customer toward a premium, higher specification model. It's about gracefully moving them from that basic entry-level option to a professional-grade model that's going to give them better efficiency, faster speeds, just better overall business outcomes. And here's the kicker. Because you're offering financing, that huge professional-grade upgrade might only cost them, an extra $40 a month? Instead of thousands of dollars out of pocket all at once.
But as with everything, timing is everything. Research from Xero actually shows that you've got to time your upsells perfectly across 3 distinct moments so you sound helpful, not pushy. First up, right before the sale. You want to present those premium options during the initial consultation while they're still weighing everything out. Second, right at checkout. This is when their buying intent is peaking. And third, after the purchase. Use your follow-up check-ins to suggest those complimentary upgrades once they've already seen the real value of your product firsthand.
Okay, but listen to this golden rule if you want to protect your deals. Keep your upsell suggestions within roughly 25% of their original budget. If a customer walks in expecting to spend a specific amount and you immediately try to double it with some aggressive upselling, you're instantly going to trigger that sticker shock, erode all the trust you've built, and honestly probably kill the whole sale. You got to keep the upgrades reasonable, highly relevant, and squarely focused on tangible benefits.
All right, bringing it home with Section 5, choosing the right partner.
To pull all of this off seamlessly, you definitely can't just hand your customer a dusty brochure for some random local bank. Your ideal partner checklist has to include a few absolute non-negotiables. First off, deep industry knowledge. They actually need to understand the very specific equipment you're selling. Second, digital speed. You want funding sorted in 24 to 48 hours, certainly not weeks. Third, and guys, this one is massive, they must use the equipment itself as the sole collateral. See, a lot of traditional banks will slap these restrictive blanket liens on a business, tying up all of their assets and strangling their financial freedom. A top-tier equipment lender, they leave the rest of the business completely alone. And finally, they've got to be willing to finance soft costs. I'm talking delivery, taxes, installation, sometimes up to 25% of the whole agreement, just to ensure your customer truly has zero out-of-pocket expenses.
When you combine strategic vendor financing with these smart upselling techniques, you aren't just selling a piece of equipment anymore. You are selling affordability, tangible business growth, and total peace of mind. So take a hard look at your own sales process today. See where you can start flipping those scary upfront costs into very approachable monthly opportunities. Because I really want to leave you with this provocative thought to chew on. Just how much revenue are you currently leaving on the table simply because you aren't offering a monthly payment option?